Credit scores. They're just three numbers, but they mean a lot. And with so much weight hanging on those digits, it's no wonder myths happen. But today, we're going to debunk the top 10 credit score myths so you can navigate the world of credit with confidence. Welcome back to our channel. We all know how important our credit scores are. They affect our ability to get loans, influence interest rates, and they can even impact our job prospects. But despite their importance, many of us are clouded by myths and misconceptions about what actually affects our credit scores, and we all know it doesn't end well. Today, we're going to set the record straight and reveal to you the 10 credit score myths. If you are eager to find out, hit that subscribe button first and turn the notification bell on for more content like this. Now, let's get started. 1. Myth 1. Unpaid tickets hurt your score. Let's dive right into our first myth, which sounds unbelievable, but most people still believe in. It is the idea that unpaid traffic tickets and library fines can damage your credit score. You may have heard from a friend who swore their credit score took a hit after they received a parking ticket and didn't pay it immediately. Or maybe you've read an alarming post on a personal finance forum that cautioned about the dire credit consequences of an overdue library book. While these stories might seem captivating, the truth is a bit less dramatic. The reality is that minor infractions like unpaid traffic tickets or library fines typically won't make their way to your credit report. According to Rod Griffin, Senior Director of Consumer Education and Advocacy at Experian, one of the three major credit bureaus in the U.S., parking tickets and library fines can be reported if they are turned over to collections, but they don't have a significant impact because they aren't considered contractual debt. While it is important to clear any fines you may have for ethical reasons and to avoid additional penalties, you can rest easy knowing that they won't be hurting your credit score. Still, it's a good practice to pay your fines on time. While we certainly encourage you to respect the law and pay your fines, know that an overdue library book or unpaid traffic ticket won't ding your credit score. 2. Myth 2. Checking your score lowers it. Let's talk about another myth that's been doing the rounds for years. Checking your credit score will lower it. Now, how many times have you heard that one? Perhaps it stopped you from regularly keeping tabs on your credit, worried that you might be doing more harm than good. However, the fact of the matter is, that's simply not true. According to financial expert John Ulsheimer, checking your own credit score does not lower it. That's right, you can breathe a sign of relief and check your score without fear. This type of inquiry is what's known as a soft credit inquiry, as opposed to a hard inquiry, which occurs when a lender or credit card issuer checks your credit when you apply for credit. Think about it like this: you're just peeking into your own financial information. It's similar to checking your bank account balance or reviewing your spending on your credit card statement. So if you've been hesitant to monitor your credit score, let's put that myth to rest right here. Regularly checking your credit score is not only safe, but it's also a smart financial move. It helps you catch any inaccuracies that may hurt your score and allows you to understand your credit health better. In fact, numerous studies have shown that people who regularly monitor their credit scores tend to have higher scores. 3. Myth 3. Carrying a credit balance helps your score. Moving on to the third myth, carrying a balance on your credit card helps your score. This is a widely circulated myth that has led many into the pitfall of unnecessary debt and high interest costs, so let's debunk it right away. Contrary to popular belief, carrying a balance on your credit card does not help your credit score. In fact, it could harm it. Carrying a balance increases your credit utilization rate, which is the ratio of your credit card balances to their respective credit limits. High credit utilization could be seen as a sign of financial risk, leading to a decrease in your credit score. It's recommended to keep this rate under 30%. Carrying a balance often means you're not paying off your card in full each month, which can lead to accrued interest charges. This can result in a larger debt that can be hard to manage and pay down, negatively affecting your financial health. Let's give you an example. If you have a credit card with a $1,000 limit and you carry a balance of $500, your credit utilization rate is 50%, which is above the recommended level. This could potentially lead to a dip in your credit score. As financial guru Dave Ramsey famously says, "Debt is dumb, cash is king." So to maintain a healthy credit score, aim to pay off your credit card balances in full each month, and don't fall for the myth that carrying a balance helps your score. 4. Myth 4. Closing unused credit cards boosts your score. Now let's talk about the fourth myth. Closing unused credit cards boosts your score. Have you ever looked at an old credit card collecting dust and thought it'd be a good idea to just close it? Well, think again. Closing unused credit cards could potentially hurt your credit score, not boost it. When you close your credit card, it affects two key elements of your credit score calculation: your credit utilization rate and your credit history. Your credit utilization rate is the percentage of available credit you're using, and closing a card reduces your available credit. This will result in a higher utilization rate, which can negatively affect your score. Closing a card could potentially shorten the length of your credit history, another important factor in your credit score. A longer credit history generally has a positive effect on your score. Here's an example for you. So you have two credit cards, both with a limit of $1,000. Now let's say you have a combined balance of $500 on these cards. If you decide to close one of them, your credit limit shrinks to $1,000, which means your utilization rate increases from a comfortable 25% to a not-so-ideal 50%. And guess what? This sudden increase in utilization could actually harm your precious credit score. 5. Myth 5. Your income influences your score. We've reached halfway, and it's time to talk about myth number 5. Your income influences your score. This is a common misconception, but your salary doesn't directly impact your credit score. Your credit score is calculated based on factors like payment history, credit utilization, length of credit history, credit mix, and new credit inquiries. Not one of these involves how much you make, but your income can indirectly impact your credit. For instance, if a high income enables you to easily pay your bills on time and keep your credit card balances low, this could increase your credit score. But don't easily believe that a fat paycheck automatically means you've got a high credit score. Even if you're pulling in six figures, your credit score can take a hit if you're late on payments, carrying hefty balances, or just sticking to one type of credit. In the end, it's not about how much money you're bringing in, but how well you handle what you've got. Gotta be smart and responsible with your finances. By the way, if you want to learn more about the best credit card hacks that banks don't want you to know about, we've got an excellent video for you. The link is in the description box below. Check it out after this video to keep boosting your financial knowledge. 6. Myth 6. A perfect score is needed for the best rates. Here's myth 6. A perfect score is needed for the best rates. While it may sound convincing, the truth is quite different. A perfect credit score, which is 850 according to FICO, isn't necessary to secure the best interest rates. Most lenders consider credit scores of 740 to 799 to be very good, and those who fall into this range are likely to receive better than average interest rates. Scores above 800 are considered excellent and may qualify for the best rates, but it's important to remember that other factors like your income and debt-to-income ratio can also influence lenders' decisions. Striving for perfection with a credit score can be exhausting and unnecessary. Instead, aim for a very good or excellent credit score range and ensure you're responsible managing your overall financial health. If you're finding this information helpful, be sure to smash that like button. Your support helps us to continue to debunk myths and provide accurate, factual information about the often confusing world of credit. Stick around as we tackle the next myth and keep clarifying the truths about your credit score. 7. Myth 7. Debit cards help build credit. Let's talk about myth 7, which is quite common. The idea that debit cards help build credit, it is simply not true. The truth is, debit cards and credit cards are not in the same league. You use debit card to access your money in your own bank account. The debit card transactions don't get reported to credit bureaus, so no, they won't make any impact on your credit history or score. It's like they're living in two different worlds. Debit cards could be handy for everyday spending, but they won't affect your credit score one bit. Remember what Benjamin Franklin said: "An investment in knowledge pays the best interest." So educate yourself about what truly impacts your credit score, and you'll be better equipped to build and maintain solid credit. 8. Myth 8. Bankruptcy erases all debt. Let's turn out myth 8, which is the idea that bankruptcy erases all debt. Firstly, not all debts can be wiped away with a bankruptcy filing. Things like student loans, child support, alimony, and certain tax obligations usually stick around even after bankruptcy. They're called non-dischargeable debts, and they're here to stay. Secondly, filing for bankruptcy is no joke when it comes to your credit score. It can tank your score by a whopping 200 points or more. And guess what? That bankruptcy record sticks around on your credit report for a solid 7 to 10 years. Talk about a long-lasting impact. It can make it harder to score credit approvals, rent a decent apartment, or even land a job. So if you're dealing with debt troubles, it's best to seek advice from financial experts before jumping into something as drastic as bankruptcy. Like this video to support our channel, and we'll continue to debunk more credit myths for you. 9. Myth 9. All debt is bad for your score. The 9th myth in our list is that all debt is bad for your score. This one is intriguing because, contrary to popular belief, not all debt is created equal, nor is it universally damaging to your credit score. Alright, let's dive into the credit world. There are two main types of debt to know: revolving debt and installment debt. Now here's the cool part: having a mix of both can actually boost your credit score. It shows lenders that you're responsible with different types of credit. Now pay attention to credit utilization. It's a fancy term for the balance to limit ratio on your credit cards. If your utilization is sky high, it can drag your score. So it's not about avoiding debt altogether, but rather managing it like a boss. Keep that balance in check. As Robert Kiyosaki famously said, good debt makes you rich and bad debt makes you poor. Basically, it's not just about having debt, but how you handle it that counts. If you're eager to dive deeper into budgeting and speeding up debt repayment, we've got you covered with another video. Just click the link in the description box below and you can catch it later. 10. Myth 10. Joint credit applications merge scores. The final myth on our list is that joint credit applications merge scores. This is far from the truth. When you and another person, be it a spouse, a business partner, or a friend, apply for credit jointly, your credit scores remain separate. Credit bureaus compute individual scores, reflecting each person's credit behavior. Joint applications do allow lenders to review both credit histories, but it doesn't amalgamate your score. However, joint applications, or being a co-signer, mean shared responsibility for the debt. So if the other party fails to make payments, your credit score could be impacted negatively. So while your scores don't merge, your financial fates are intertwined. By the way, a quick question: what's one credit myth you believed in before watching this video? Let us know in the comments below. And that wraps up our list of top 10 credit score myths. Remember, understanding the reality behind these myths is crucial in managing and improving your credit score. Let's continue to make informed financial decisions and boost our financial well-being. If you found this video helpful, please give us a thumbs up and don't forget to subscribe for more myth-busting financial content. Thank you for watching. We'll see you in the next one.